Just a short time ago, the Federal Reserve raised interest rates again. Federal Reserve Chairman Jerome Powell announcing that the Fed is raising the rate by 0.25%. Chairman Powell spoke at the press conference announcing his decision. Here's part of what he said.
Inflation remains too high, and the labor market continues to be very tight. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal.
This is the 9th time in the past year that the Fed has raised interest rates. Earlier today, I spoke with Idaho Senator Mike Crapo. He is the ranking member of the Senate Finance Committee. Senator, thank you for joining me, sir.
Thank you. It's great to be with you, Greta.
Senator, news today that Federal Reserve Chair has announced that the interest rate will go up another 1/4 point. Do you think this will help reduce the overheated economy we currently have?
Well, I do think it was the right decision by the Fed. They were faced with a real problem. If they raised the rate, they would help fight inflation better, but they would have put a little more pressure on the interest rate risk being faced in our banking sector. If they didn't raise the rate, then they would have basically slowed the fight against inflation. And I frankly think that inflation is the bigger problem. Our inflation rate today is 6%. And remember, that's over last year. If you look at compared to the beginning of the Biden administration, we're still at about a 14% total inflationary impact. That's slamming the American people. We don't need to see these higher interest rates, but we have to keep looking at them, in my opinion, as long as the administration continues pushing this inflationary policy. And I'll just add to that, the budget that the president sent to us just a week or two ago has $4.8 trillion of new taxes and trillions of dollars in new spending, more inflationary pressure. So I think the Fed did what it had to do.
All right, well, our goal is 2%, and we're far off from that for an inflation rate. There are some who predict that we could, by the end of the year, be down to 4%. Is that 4% realistic to be down to by the end of the year? Because this really, as you noted, is really hurting many Americans, especially those on fixed incomes.
Yeah, the inflation is slamming people. You'd have to have a 14.8% wage increase just to be holding even against the inflation. And I don't know whether we can get to 4% by the end of the year. I hope it is realistic. But let's remember, even if we get to 4% by the end of the year, it's still double what the administration inherited and double what the Fed's target interest rate is. Target inflation rate is. We've got to get a handle on inflation.
The banking system, we've seen what's happened to a couple banks, which has shaken many people in the country, certainly has shaken those people who do banking with those banks. Would stress tests, if they had done those stress tests, if the rules hadn't been changed a little bit in 2018, raising the minimum amount of money before you had to do a stress test, would we have gotten notice and prevented those banks from failing?
Well, first of all, I was the author of that 2018 bill, and no, it wouldn't have changed anything. The reality is we did not eliminate stress tests. We said that the Fed didn't have to apply the same stress test to banks with over $250 billion in assets that it did to smaller banks. But the tests, the Fed was given full authority to do strict stress testing, and they did. In fact, SVB had over 150% of the capital that it would have had under the original stress test that we said they could have tailored. So this argument that the 2018 reforms took away stress testing or that it made the banks less capitalized is simply not true. The reality here is the banks were heavily capitalized, and the issue that they are facing now is not capital. It is interest rate risk. It's something driven by the fact that inflation has forced serious problems onto the economy, and the Fed's response with hiking interest rates has put the banks into a liquidity crisis, not a capital crisis.
Is that in part due to the fact that they did that, at least for Silicon Valley Bank, is that it didn't have a very diverse portfolio in terms of its depositors? Was that part of a problem, the type of deposits they had?
Oh, yes. The management at Silicon Valley Bank has serious responsibility in this, in my opinion. They were heavily into the tech sector in terms of their portfolio, and in terms of their capital, they were heavily into federal treasury bonds, which is the source of capital that the Federal Reserve policy has generally encouraged banks to do. But with the interest rate risk and the inflation that I mentioned earlier, those capital assets were devalued, and it put the banks, as I said, into a liquidity crisis. Not that they didn't have capital, but they couldn't access their capital because of these dynamics.
Senator, thank you very much for joining me, sir.
Thank you. Great to be with you today.